I think the street's leaning. I think the street's not long. I think the street's leaning short to flat bond positions. I think traders.
Keep it tight over there, Sosnoff.
What do you got for us today?
Gentlemen, it's the day before your favorite day of any given month. Happens 8 times a year. Tomorrow's the Fed meeting, so I wish you both well on this pre-FOMC eve. Of course, markets are fairly staid as we look at price action here this morning. That's not atypical, of course. There is a little bit of a pre-FOMC drift that occurs where markets tend to coil up as traders keep their powder dry. But like the last few big economic data releases, it feels like this is a Fed meeting that may not be that important to markets. I feel like this is a recurring theme here on Let Me Explain. We talk about a CPI release, a non-farm payrolls release, Fed Chair Powell's speech at Jackson Hole, and we can't help but look at it and say, this is an event that the market really doesn't think is that serious. And sure enough, when we look to the options market once more, it does not appear to be something that could be a big mover. S&P 500 options are pricing in less than a 1% move to the end of the day tomorrow. NASDAQ just a hair over 1%. Russell right around 1.5%, which all things considered makes sense given the sensitivity to bond markets recently. I guess the question is, what surprise can the Fed bring us? Tomorrow is one of the 4 meetings of the year in which they bring forth a new summary of economic projections. We'll hear their new growth, inflation, and unemployment forecasts, as well as a new dot plot, which is everyone's favorite Rorschach test for what's going on in the market. But I think it's worth reminding people that the Fed has been insisting that they want to stay higher, or at least high, for longer. In the June dot plot, we saw that they were projecting 2 more hikes in 2023 and potentially 4 cuts in 2024. We already got one of those hikes this year in July. For tomorrow's meeting, there is a 1% chance, according to the CME FedWatch tool, that we see a rate hike. And in November, there's about a 31% chance that we see a rate hike. So the Fed does not need to tell us that they are raising rates. They can simply signal that they have the intent to potentially do so again in order to maintain that hawkish stance. They can upgrade their growth forecast for this year. They can upgrade their labor market forecast for this year. They can say that inflation will be turning higher thanks to moves in the energy market. But all that is kind of known. That's not unexpected, given the scoreboard that we've seen recently about U.S. economic data. And so barring a significant surprise, which I think the bar is pretty high to give us one, we've referenced the fact that anytime there's been a 55% chance or more of a rate hike or rate cut in either direction, the Fed's delivered 100% of the time, and we are nowhere near that with a 1% chance priced in. It seems like tomorrow's Fed meeting could come and go without so much as anyone losing sleep, particularly you two. So I want to say I'm sorry, gentlemen. I know you guys get really excited for these Fed meetings. Tomorrow may not be the day where you expect to see a significant swing in prices.
I would agree with that. I would agree with that assessment. I don't care about all the background stuff, but on the surface, I would agree that tomorrow is going to be a day that I don't think we're going to get that excited about the about price movement. But my experience tells me that my trading experience tells me that kind of when you least expect it, kind of expected type thing. And I feel like the bond market has been out of sight, out of mind all year, in the sense that I'm not sure that, I don't even know if, other than a few Fed talk and things like that, I don't think I've ever seen less interest in bonds than we've seen this year. Like, I haven't heard one person basically saying, hey, you know what, you should be buying bonds here or this. Like the whole world's turned so, I mean, wouldn't you say that the sentiment about being long any kind of debt here is just so negative that I just don't think people have, long bond positions right now. And so if I was looking at a space that to me seemed like it had, I don't know, maybe a lot of capitulation already take place, and on a day when the announcement is assumed to be not much of anything, wouldn't you think that there's a little room for a surprise tomorrow to the upside?
I think bonds are the place to watch right now for 2 reasons. First off, there is the historical tendency for bond markets to bottom at the meeting prior to the final rate hike, if you go back and look at the data available since 1990. Maybe that rate hike was in July, but the Fed continues to suggest that it can do more. And if that final rate hike that they could potentially deliver is in November, that makes this the meeting prior to the final meeting where there could be a rate hike. The other side of this is that the market, in terms of capitulation, actually, I would argue that it hasn't capitulated yet. One of the things that we like to look at on Futures Power Hour every Monday are changes in the CFTC's COT report. In particular, we like to look at the changes in speculative positioning or net non-commercial positioning. Why? Because if you look at the data, speculators, people that aren't hedging for economic reasons, they tend to be trend followers, which means that they are right for the bulk of the move. They are longest at the top and they are shortest at the bottom. And when we look to the Treasury market positioning right now, speculators, non-commercial entities have never been more short the bond market than they have right now.
Okay.
And so there is a lot of short covering that could go on out there. If the Fed were to signal that they feel like they're done or they're close to being done, that even if they deliver a hike in November, they still intend on delivering 4, maybe more cuts next year, and that could be starting in June, then you have some credible evidence on your hand to suggest, well, this is a really, really, really crowded position right now. Everyone and their mother's short already. Who's left to pile into this trade? Risk reward, it kind of makes sense to start looking long bonds at this point in time. We've discussed this in recent weeks where if you're looking at selling put spreads in ZB or ZN underneath last year's lows, the bond market was telling you that the odds of getting through those lows by the end of this month were fairly slim, under 20% most of the time. And sure enough, we haven't exactly taken out those lows yet. So I do think in terms of the convexity of a trade, do you want to be long bonds here or short bonds here? Well, I think there's greater upside in being long bonds. You just may need to hunker down and wear it out for a little while.
Yeah. So, I'm not sure the marketplace is telling us too much, but the October bonds have right now about a 12% implied. I'm just talking about implied volatility. So, like from an expected move, like perspective, they have about a 12% implied volatility. If you jump over to SPX, let's see. If I talk about the front month, well, essentially, let's talk VIX for a second. Where are we right here in front month?
VIX?
No, SPX.
SPX, you're looking at an IV of 17. 17 and a half on the 0 day, 17 on the 1 day.
Yeah.
I thought
it was going to be closer because the VIX was, I thought the VIX was a little lower. Maybe I'm off by a little bit. I thought they were going to be like lining up around the same, but they're not.
We got the roll in the VIX coming on Wednesday too, I think.
Oh, is that what it is? Yeah.
So take a look.
No, I was wrong. I wanted to show you something, Chris, but I don't think the actual price fits my argument. I think that. Yeah, I don't like that argument. So I'm just going to go with what you said just a few seconds ago, which is, I think the street's leaning. I think the street's not long. I think the street's leaning short to flat bond positions. I think traders are long bonds. I think the street is short bonds, and I think from a risk reward side, there's probably a few extra handles to the upside than the downside if you looked at it at a 50-50 bet. I think that's the only thing I'm playing. Like somebody just wrote me an email and said, why are you even wasting your time in the bond market? And I'm thinking, well, only because there's not that many places with what I consider to be decent pot odds. Is that a reasonable answer? I mean, in this market, it may be your best answer.
I would agree. I mean, I look at the NASDAQ and the S&P 500 right now. They're basically in a technical no man's land, and sure, that could be a good reason to think about range trading. But what premium are you going to collect by selling options here? So if you're going to play this, you're going to have to play it on a very short-term basis. You're going to have to trade small. You're going to have to be nimble, be willing to get in and out of positions. Strong convictions held very, very loosely right now. Directionally, there's no place to take a bet right now. I mean, I look at the S&P 500. It's consolidating what I think to be a triangle. That's a great deal of potential energy storing up. We'll like to trade the kinetic energy breakout as someone who prefers to trade on a momentum basis. But until then, the spring coils and coils and coils. So why would I want to take any position one way or the other right now? I'm just kind of sitting with what I have and letting the positions I have work for me or some of them work against me, like dollar yen, as I wait for intervention. But in any event, I agree. I mean, there's only a few places to me that are really compelling, one of which is actually gold. I was a really big fan of gold in April, May, in the run up to that U.S. debt ceiling debate and whether or not we would default, kind of running back the 2011 playbook. But as we saw in 2011, once that cleared the deck, gold underperformed, bonds outperformed, stocks were able to rebound. And we saw a little bit of that in June. But I think about the prospects for gold here right now, and unlike stocks, gold can have a more positive relationship with volatility. Vol is really, really low in gold right now. I look at some of these longer dated options, and I think about the potential risk coming down the horizon. I think about a U.S. government shutdown. I think about escalation and a potential conflict between Russia and Ukraine, and what other entrants like a China or North Korea couldn't get involved in the conflict. And those things to me seem like geopolitical tail risks that are worth holding on to for precious metals. The other side of this is that real yields, which gold and silver historically have very negative relationships with, are now persisting near multi-decade highs. In fact, if we were to close at these levels on a monthly basis in the 5s, 7s, 10s, or 30 real yields, these would be the highest closes that we've seen since the global financial crisis. But gold and silver are nowhere near their lows of this year. They've been quite resilient, all things considered. You can sprinkle in the strong dollar there too. And so if there's any sort of retrenchment in bond yields, in real yields over the next few weeks, then gold and silver seem really, really well positioned. I actually like looking beyond the typical 45 DTE cycle, looking more out to like 70 days or so, the end of November, the end of December, for potential trades, because one, it brings diversification and uncorrelated position to the rest of the portfolio, the rest of your trade book right now. And it doesn't really line up with any of those short-term factors that we've been looking at and talking about here on Let Me Explain Over Time or Futures Power Hour. I've been listening to some of your programming too. It seems like it's a good thing to have in your pocket in the event that something goes sideways. I think gold right now has a great deal of high convexity to the upside. Those are pot odds that I do like in this market.
Yeah. So with gold, we looked at gold yesterday. The volatility in gold is actually below the volatility in bonds, which happens like once in, I don't even know when the last time that's ever happened. Gold's trading with an 11 vol. And when you think about gold 11 vol, I mean, we've seen it trade as high as 60. 11's crazy. And
it could be under that now, 10 and a half too. Yeah. So it's not like it's expanding.
Gold's trading below bonds.
I
feel like gold is, I get your whole argument on gold. I feel like gold is, with vol where it is right now, it's a range bound bet. That's, you just flip a coin, range bound. I mean, I would rather be long it than short it, like you. I'd rather be long it than short it. But I feel like bonds actually have real pot odds, because when you look at bonds are like on their lows, and they're interesting at this level. Like they could easily have a pop. When you look at gold, it's kind of nowhere absolutely mid range.
Yeah.
There's nothing there. Like there's no. It's not any kind of extreme.
But he's talking about his scenario. If his scenario plays out,
I said scenario wise, I'd rather be long gold than I'd rather be long gold than short it. But I think bond wise, I just think they're a little more interesting. The volatility in gold is just too low to play it as a directional bet right now. It's too low to be short premium. I have a gold position on. Here's the crazy thing. I've been short front month volatility in gold and long back month volatility in horizontal fashion for almost a month now. I've made 1 penny. Like I can't figure out how to make a penny in gold. Like I've had the perfect position on for this market, and it hasn't moved against me. It hasn't moved for me. It hasn't moved a penny. Like you can't squeeze any money out of the gold market in this current low volatility environment. It's just impossible. We have some calendar spreads on in GLD. We have some horizontal spreads on in GC. Neither one has made or lost a dime. So I think gold, just like the whole thing with, the cool thing about Tasty is we talk about all these different things, but I want to focus on like what's practical. And I think gold right now and silver, really hard markets to trade, not really a good practical trade in there. Bonds, on the other hand, have a little bit more, they have more juice at 12% volatility compared to their historical, and there's still enough in there that maybe there's and they're cheap enough on an extreme that maybe there's enough in there for a trade. That's the only thing I'm thinking. Like I'm just a trader, squirrel searching for a nut, trader searching for a trade. Same thing.
I mean, definitely around the Fed meeting, I'd rather be looking at the bond market. In terms of the gold trade that I'm thinking of, I'm looking out to say GC Z3 long call vertical. 2000 and 2020 strikes.
Yeah, the
It only
problem
says that
is though that you're down to, when you look at the statistics, like if you do because of where vol is right now, like just looking at what you're saying, like if you went out to, what'd you say, Nov or Dece?
Yeah.
Nov. So you
You're
pretty
looking at
much
$65 expected.
yeah,
move.
you're talking about, what'd you say, the 220s, 2020?
2000 and 2020.
Yeah, 2020. I mean, you're at 25 deltas. So, that's the problem.
50% chance of a touch because $65.
Yeah, 50%
expected
chance of
move
a
right there.
touch and a 25% chance of closing above that. It's just a tough trade. I mean, and that's going out, 70 days.
Mm-hmm.
It's just a tough trade. That's all. There's not a lot there. Right now, I'd say there's better opportunities in bonds. I'd say there's better opportunities in stocks. Like stocks are at least, moving around.
Some. Yeah, I'll give you that.
Where else? What do you think, Chris? Where else could the Fed influence the markets tomorrow in just some capacity? Like what else could a Fed, like just delaying the whole, I'll end it on this. Fed comes in, they say, okay, we're just gonna place a hold on everything right now. What equity markets does that impact where does that take the risk off of, and where does it add risk to? Like what equity markets?
I think it's adding more risk to the Russell right now. Quite frankly, bond yields persisting at these levels has been really bad for the
Wrong
banks.
answer. No, I'm just kidding. Top long Russell, short Nasdaq. You wanted to say Nasdaq gets creamed. Wrong answer.
I'm aware. KRE, though, the regional banks have been underperforming the broader market again for the past few weeks. And that to me is a major warning sign. It's a little red flag that's ticking up on my screen. Yesterday was a pretty glaring day. KRE is starting to break down once more. We know that these banks have these large unrealized losses sitting on their balance sheets. And sure, the Fed facility is in place. They're giving plenty of liquidity out there. But these are zombie institutions. And in the event that we see commercial real estate start to go belly up, which there are signs of that happening around the country right now, the regional banks are going to be some of the hardest hit, plain and simple. So bond yields staying higher for longer or staying high for longer, it doesn't matter if we don't see another rate hike. It's just a function of time and math. These balance sheets are getting squeezed more and more with each passing day. And that's really bad news for the Russell. I think it's a really bad omen right now, given the price action we've seen in RTY compared to what's happening in NQ or ES. It's not something that leads me to believe that there's much confidence in an upside move in the broader stock market altogether. Russell needs to get off the mat if ES and NQ want to rally here.
We can leave it right there.
You could leave it there. Yeah, I have a lot to say
win.
about that, but I wrote about that in the chair bomb on Sunday. I actually think differently because I think that the pendulum is going to swing the other way, and the leverage is going to go towards move away from the underlyings that have highly concentrated institutional holdings into a much more diversified set of global. They have to sector rotate for people that want to stay long, passively long. They're going to have to do some sector rotation into into outside of the top 10 stocks. They're going to have to. I think when the process of doing that, they're going to have to buy small cap. And it's not going to be a function of, it's not going to be a bank risk. It's really going to be just a function of sector rotation.
Okay.
That's what I think, but we'll see. All right, Chris, as we say goodbye here, S&P's down almost
23, 24.
Yeah.
Nice call, Bat.
Big move today. Thanks, Chris.
Thanks, Chris. Appreciate your time. We'll take a
Joe?
quick 90-second break and come back. We got more Tasty Live after this with a market measure. We'll be back in 90 seconds.